What if your investments could pay your phone bill, cover your gym membership, or even help with groceries every single month? Today, I'll show you exactly how to make $100 a month in dividends, passive income that lands in your account while you sleep. Whether you're new to investing or looking to boost your cash flow, this is your step-by-step guide. Let me take you back to a moment that changed how I viewed money. A few years ago, I received my very first dividend payment. It was a measly $4.37, barely enough for a coffee, but it felt like pure magic. That small sum wasn't earned through a side hustle or a 9-to-5 job. It came simply because I owned a few shares of a company. That moment sparked a fire in me, and I set my sights on a bigger goal: $100 a month in dividends. For some, $100 a month might mean filling up the gas tank without a second thought. For others, it's a little extra cushion in the budget or a step toward financial peace of mind. The beauty of this goal? It's achievable with a clear plan, the right investments, and a bit of patience. My journey to $100 a month wasn't overnight, but it taught me the power of passive income and how anyone can harness it with the right approach. Step 1. Know your target. Before we jump into the specifics, let's get crystal clear on what we're aiming for. To generate $100 per month in dividends, you need to build an investment portfolio that produces $1,200 per year in dividend payments, $100 times 12 months. This is your North Star. The size of your portfolio and the types of investments you choose will determine how quickly you reach this target. The good news? You don't need to be a Wall Street wizard or have $1 million to make this happen. By understanding the math and selecting the right investments, you can create a steady stream of income that grows over time. Let's break down the steps to get there. Step 2, pick your approach. When it comes to building a dividend portfolio, you've got two primary paths to choose from, each with its own pros and cons. Your choice depends on your risk tolerance, investment timeline, and how much capital you're starting with. Low-yield, high-quality ETFs. These are the set-it-and-forget-it options for investors who prioritize stability over immediate income. Funds like the Vanguard S&P 500 ETF, VOO, or the Schwab U.S. Dividend Equity ETF, SCHD, invest in large, well-established companies with a history of paying consistent dividends. These ETFs typically offer lower dividend yields, around 2% for VOO and 4% for SCHD, but they come with lower risk and the potential for long-term capital appreciation. They're perfect for beginners or conservative investors who want exposure to blue-chip companies like Apple, Microsoft, or Procter & Gamble without betting on a single stock. The trade-off? You'll need a larger upfront investment to hit your $100 per month goal. High-yield ETFs or stocks. If you're looking to reach $100 a month with less capital, high-yield investments might be your ticket. Options like the S&P 500 High-Income ETF, SPYI, which boasts a 12% yield, or business development companies, BDCs, like PennantPark Floating Rate Capital, PFLT, which often pay 8 to 12% yields, can deliver more income per dollar invested. These investments generate higher payouts because they focus on riskier assets, such as small businesses or income-generating strategies like covered calls. While the higher yield is enticing, it comes with increased volatility and the potential for dividend cuts if the underlying investments underperform. These are better suited for investors comfortable with some risk and willing to do their homework. To decide which approach is right for you, consider your financial goals. Are you building for long-term wealth with safety in mind, or are you focused on generating cash flow now? A balanced portfolio might even combine both strategies: some stable, low-yield ETFs for growth, and a few high-yield picks for immediate income. Step 3. How much do you need to invest? Now let's crunch the numbers to see how much you need to invest to hit that $100 per month target. The amount depends on the dividend yield of your chosen investments. Dividend yield is simply the annual dividend payment divided by the stock or ETF's price, expressed as a percentage. Higher yields mean you need less capital, while lower yields require more. Here's how it breaks down. High-yield ETF like SPYI, 12% yield. To generate $1,200 per year, you'd need approximately $9,500 invested. That's because $9,500 times 0.12 equals $1,140, which is close enough to your goal, and slight fluctuations in dividends can push you over the $100 per month mark, which generates extra income but can limit upside potential in a booming market. Classic ETF like SCHD, 4% yield. With a 4% yield, you'd need about $30,000 invested. That's $30,000 times 0.04 equals $1,200 per year. SCHD focuses on companies with strong dividend growth, meaning your income could increase over time as these companies raise their payouts. Super safe low-yield ETF like VOO, 2% yield. For a 2% yield, you're looking at around $60,000 invested. VOO tracks the S&P 500, so you get broad market exposure. But the lower yield means you need a much larger portfolio to hit your income goal. To achieve $100 a month in dividends, the investment required depends on the yield. A 12% yield, like SPYI, needs about $9,500 to generate $1,140 annually, or $95 per month. A 4% yield, like SCHD, requires $30,000 for $1,200 yearly, $100 a month. A 2% yield, like VOO, demands $60,000 for the same $1,200. These assume a fresh start, but adjust if you hold investments. Higher yields mean less capital, but they carry risks we'll discuss later. Step 4. Build your portfolio. With your target and approach in mind, it's time to construct your dividend portfolio. Here are 3 key principles to follow. Diversify. Never put all your eggs in one basket. A diversified portfolio reduces risk by spreading your investments across different sectors, industries, and asset types. For example, you might allocate 40% to a high-yield ETF like SPYI, 30% to a stable dividend grower like SCHD, and 30% to individual monthly paying stocks like Realty Income O. A real estate investment trust, REITs, known as the Monthly Dividend Company, or Main Street Capital, MAIN, a BDC that supports small businesses. This mix balances income, growth, and stability. Focus on monthly payers. To make your $100 per month goal feel tangible, prioritize investments that pay dividends monthly rather than quarterly. Monthly payers like Realty Income, Main Street Capital, or SPYI deliver consistent cash flow, making it easier to cover regular expenses. Check each investment's dividend schedule before buying to ensure it aligns with your needs. Reinvest dividends. If you don't need the $100 per month immediately, consider enrolling in a dividend reinvestment plan, DRIP. DRIPs automatically use your dividends to buy more shares, compounding your income over time. For example, reinvesting a $100 dividend from SPYI at $50 per share buys you 2 additional shares, which then generate their own dividends. The snowball effect can significantly accelerate your journey to $100 per month and beyond. When selecting individual stocks or ETFs, research their dividend history, payout ratio, the percentage of earnings paid as dividends, and overall financial health. A company with a 10% yield but a shaky balance sheet might cut its dividend, derailing your plan. Use resources like company earnings reports, ETF fact sheets, or financial news to make informed choices. Step 5. Automate and track. Building a dividend portfolio isn't a one-time task. It's a habit. To stay consistent, automate your investments through your brokerage account. Most platforms like Fidelity, Schwab, or Robinhood let you set up recurring purchases, so you're buying shares of your chosen ETFs or stocks every month or paycheck. Even $100 to $200 a month adds up over time, especially with reinvested dividends. Tracking your progress is equally important. Create a simple spreadsheet to monitor your portfolio's value, monthly dividend income, and yield. Include columns for the investment name, shares owned, dividend per share, and total monthly payout. Alternatively, use free apps like Personal Capital, Dividend Tracker, or your brokerage's dashboard to visualize your growth. Watching your dividends climb from $10 to $50 to $100 a month is incredibly motivating and keeps you focused on your goal. Step 6. Watch out for risks. I've seen people cross the $100 per month mark in less than a year by focusing on high-yield ETFs and reinvesting every penny. It's not instant, but with discipline and patience, you'll get there. Ready to make your first $100 a month in dividends? Drop your favorite dividend stock or ETF in the comments. Like, subscribe, and hit the bell for more tips on building passive income with stocks, tech, and investing. Your journey to financial freedom starts now,